Hey guys, this is Adam from dodjits.com and this is your video briefing for Monday the 20th of July 2009. Now, I'm sorry we didn't get this post out earlier over the weekend. We normally try to do that to get you prepared for the following week. I had a birthday this weekend, so I was celebrating a little bit. I was quite drunk. I couldn't stand up properly yesterday, so I thought I'd better do this video today, show you what we've been doing all last week, and this is stuff that we've been posting all throughout the website. You know, it's not we're not keeping here any secrets at all, so we're going to just show you what we did. Let's see where we're heading and how we're going to play these markets now, because it might be a little bit of a problem at the moment. Let's slowly glide into the market. See, we're going to start with the S&P 500 like we normally do, the broader market, and let's see what we've been doing. Alright, so basically, we had this head and shoulders pattern right around here. We've got the left shoulder here, the head around here, the right shoulder around here. And, you know, we did show you this head and shoulders pattern. We showed you the neckline, that it broke the neckline. But what did we state? We stated that we are in a ranging market. Now, for those of you who read the reports, the charts, stuff like that, check out the charts from time to time on the site, you would have seen that we were talking about a ranging market for quite a while. We were talking that normally what you're going to have to do is you're going to have to adapt your strategy in a ranging market, and normally what you're going to want to do is play off of support and resistance, because in a ranging market what's normally going to happen is we're going to receive this kind of consolidation pattern, we're going to bounce off support and resistance, and that's exactly what we've been doing at the moment, and we showed this on numerous charts throughout the whole of the website. So, you know, basically what did we do? We saw this head and shoulders pattern, we saw this potential reversal, but then again we also saw that there was a lot of support around this area. We had the 200-day moving average, we had our support of 877.86, we had this tri-star doji around here, and we showed you this thing last week. And what we did state is probably we're gonna bounce off this area, and we're gonna probably hit our trend line resistance roughly around here. So basically what we did, we took a small position on this, and this just played out perfectly. We took a position around support, we kept it and just smashed through our resistance level, and it's now coming up to our second resistance level roughly around here. And this is where there's going to be a little bit of a problem, because I don't expect us to ram through this area. I don't think it's going to be as easy as it was around here. We received this nice gap up around here, and the reason for that is because, number one, you can see Friday's action, dodgy like candlestick. These dodges normally tend to signal a little bit of a reversal, or, you know, some pressure, some uncertainty around certain areas. So if we're talking about the 943.96 area at the moment, so then yeah, there's a lot of uncertainty around this area, because we've still got these, you know, skeptics in the market that still don't believe that we're going to head higher. We've been talking already for a long time. We're bullish this market. Even when we did break down on the head and shoulders pattern, we were talking that we were still bullish this market. I think it is safe to say at the moment that we're not going to head down to touch our lows of March. I don't see it happening. We've got the techs that are really rallying forward at the moment. So this market does look like it's bullish, but we are going to need confirmation, and that confirmation is going to come when we break our resistance area around here. So we could stall a little bit around this area. Let's just bring up the tech chart, show you what we're looking at. And what I'm using this time, I'm not using the index itself, because I want to show you the volume on the trust fund, on the QQQs. And basically, look at this. We broke out of our resistance. We just tapped out of it. You can see Friday's candlestick completely closed out of it. Does look bullish. And we also know, listen, we know from past experience, that especially from this rally, all along here, we can see that techs really led the market higher. Now, look at this volume around here. This is really great. Look at this. This is absolutely amazing. A lot of accumulation around this area. And I think to get this really going, this chart really going, you know, rallying higher, I think we're going to need confirmation from the S&P 500, from the Dow, from the other indexes. If that happens, so then yeah, it's like full steam ahead. If it doesn't happen, so yeah, watch out. We could continue in resistance, and you just continue to play off support, resistance, bounce, up, down, up, down, up, down. You get the idea. We've shown you this a lot. Let's just move on now to the next chart. And the chart that I brought up is the pound against the dollar. This is for you currency traders out there. Now check this out. This is what I'm looking at the moment. This is a really nice potential trade. Even though we've got a lot of problems in England at the moment, the IMF came out, they said that the deficit is really large at the moment, and it's reaching outstanding levels of GDP, stuff like that. But basically what it means is that the debt in the UK is outrageous at the moment, and this is because of all the stimulus plans and all of that stuff. But if you look carefully, look at this. We've got this bullish triangle pattern. We just bring the line up like that, roughly like that, and we take our resistance level roughly around here. We've got this bullish triangle pattern happening around here. Now, how would you really play this, especially with this spike around here? You can see we tried to break out of it once and we received this fake out. So at the moment there's really not much you can do, especially on this pair, and the reason for that is just due to risk reward. You're not going to risk a position now to try to take it up maybe 200 pips, especially if you're going long positions. If you are a day trader, so yes, you can work on this area. You might be taking 50 pips here, 50 pips there, 100 pips here, 100 pips there, stuff like that. I'm normally a longer term trader. You can see also from the videos I normally tend to take positions for a couple of days, couple of weeks sometimes, and believe me or not, I've even taken some positions for a couple of months. It really depends on the market. Basically, I'm looking for a breakout to the upside on the pound against the dollar. I'm hoping this time that I'm going to receive a full candlestick above our resistance level and not a spike out like this, roughly around here. And then if I do receive a breakout, so then yeah, it might give me a little bit more certainty to enter the trade, put my stop loss, and just, follow through with the trade. Let's see what else is out there. This chart is the euro against the dollar. Now check out this chart. We did show you this trade, but we also stated that the risk reward on this trade isn't really that large, and it wasn't really worth going into it. We showed this on one of the daily reports. Number one, we've got resistance roughly around here. If you do enter this trade, think about it at the moment. All the markets, they're still consolidating, apart from the Nasdaq that's broken higher. If you look at also all the FOREX charts, they're all consolidating at the moment. So, to take the odd trade here or there, thinking it's going to go higher, it's just not going to happen. There's no point bashing your head in the wall. We have to receive overall market movement, and once we receive overall market movements, then you'll see also that on all the currency pairs, they're going to really start to move. So if you're thinking of trading the euro against the US dollar, I would wait for a break of the 1.43380 level. If you're thinking of taking a short trade, maybe up to that level, I don't know, doesn't look like it's following through at the moment. And if the S&P 500 doesn't break its resistance level that we were talking about, so then this is not going to go anywhere. It's just going to continue to range, and you're probably going to get stopped out. So watch out for that. Now the last chart that I want to show you guys is the New Zealand US dollar. This is also a potential breakout. Obviously wait for a clear candle above the resistance level. We've got resistance around here. We've got this nice consolidation pattern around here, and we are starting to linger around our resistance level. Obviously if all the markets break out, if we start to receive these nice trends, so then this is going to climb higher. Then we've got our target level roughly around here. This could be a nice trade. Just keep an eye out on this though. Like I've mentioned numerous times in these videos as well, you have to be aware of what's going on around you. You just can't trade one individual pair and hope that it's going to go in the direction that you want it to go, because it just won't happen. It won't happen. You have to be aware of what's going on in the market, what's happening, and take your trades accordingly. Watch out for the break of the S&P 500. We've already received it on the Nasdaq. See how the currency pairs follow through. They should follow through in the same type of direction like the US market's going. Hope you enjoyed the video. My name is Adam from dodjits.com.